questions over how quickly to move participants highlighted the uncertainty associated with how long a restrictive monetary policy stance would need to be maintained, the summary said. Officials remained concerned that elevated inflation continued to harm households, especially those with limited means to absorb higher prices, the minutes said. While the inflation data had indicated significant disinflation in the second half of last year, participants observed that they would be carefully assessing incoming data in judging whether inflation was moving down sustainably toward 2%. The minutes reflected an internal debate over how quickly the Fed will want to move considering the uncertainty about the outlook. Since the January 31 meeting, the cautionary approach has borne out, as separate readings on consumer and producer prices showed inflation running hotter than expected and still well ahead of the Fed's 2% 12-month target. Multiple officials in recent weeks have indicated a patient approach toward loosening monetary policy. A stable economy, which grew at a 2.5% annualized pace in 2023, has encouraged FOMC members that the succession of 11 interest rate hikes implemented in 2022 and 2023 have not substantially hampered growth. To the contrary, the U.S. labor market has continued to expand at a brisk pace, adding 353,000 non-farm payroll positions in January. First quarter economic data thus far is pointing to GDP growth of 2.9%, according to the Atlanta Federal. Along with the discussion on rates, members also brought up the bond holdings on the Fed's balance sheet. Since June 2022, the central bank has allowed more than $1.3 trillion in treasuries and mortgage-backed securities to roll off rather than reinvesting proceeds as usual.